Boa tarde a todos. Good afternoon, everybody. Thank you for joining this webinar of BTG Pactual and New York University and Schack Institute of Real Estate. We have today a very interesting webinar about the real estate market in Brazil and US after the pandemic time. Having here with us two experts in this market, Sam Chandan, Dean of the Schack Institute of Real Estate of New York University, and Daniel Cherman, President of Tishman Speyer in Brazil. As a board member and in the name of New York University, I want to give my thanks to BTG Pactual to make it happen, this webinar. And from now on, Michel Wurman is going to moderate this panel. Thank you, Michel, and please, you have the floor from now on.
Daniel, thanks also for the audience. We are very happy to have this audience here. This webinar, a very interesting point, how to discuss about what's going to happen in real estate, taking care of what's happening in the US, what's going to happen in Brazil. So I work at BTG. I run the real estate investments in the bank. We have around $4 billion under management right now, probably the largest real estate asset manager in the region. We have more than 500,000 investors, several REITs. And now let's go to what's more important. Sam, let's start. What are your thoughts about the crisis and the perspective for the future in real estate regarding the US?
Sure. Well, first, let me just say what a delight it is to be here with you and Daniel, and any chance to see my great friend Renato. Who's it's just such a blessing to have him involved in supporting NYU and the students at the Schack Institute. I think in terms of what's happening in the United States now, we're in a very different position from where we were 3 months ago, 6 months ago, certainly where we were this time last year. There's a tremendous level of optimism in terms of the resilience of the economy, the degree to which we're likely to see some improvements in the outcomes in the job market in the United States. The last couple of months have been a bit disappointing, but those numbers are likely to improve. In part because those job numbers are anticipated to improve, because high income earners have seen a largely full return to pre-pandemic levels of employment. Couple that with the extraordinary fiscal and monetary policy interventions that we've had from our federal government in terms of stimulus packages, support for working families, now on the cusp of a new infrastructure package that will see up to $1 trillion or more of investment in new physical and workforce infrastructure in the United States. We're optimistic enough about the outlook in the baseline scenario for the economy that it's raising concerns about the potential for above target inflation. And certainly that's a concern for real estate. It has been many years since we have seen monetary policy in the United States have to tighten in response to an increase in inflationary pressures. And really sort of in the years that have followed the great financial crisis, more than a decade now, well over a decade, we have not had to contend with upward pressure on cap rates, on debt yields, on borrowing costs. And, those are some of the concerns in terms of what we see happening in some parts of the real estate capital markets. Overall, though, I'll come back to my initial point. As an economist who's also an epidemiologist, I'm very aware of the potential for variants to emerge that will impact the efficacy of the vaccines that we have available to us and that we've been broadly deploying to support the population and the resumption of activity. Very mindful of the fact that while we've made significant progress in our vaccination campaign in the United States, until we make comparable progress around the world, that potential, the human toll of the pandemic, remains a reality on the ground, in countries around the planet where the vaccine has not yet been deployed in a significant way. Not every country, very few countries have the luxury of returning to the degree of normalcy that we see here in the United States. And it is a risk for all of us because of the potential for variants to emerge. And we've seen how, depending upon the nature of the mutation, the virus may be more transmissible. It may exhibit higher rates of morbidity or mortality. These are all very real issues for us. If we remain along the baseline scenario, though, Michel, where we're deploying the vaccine more broadly, it remains effective against the variants that will continue undoubtedly to emerge over the course of the next year, the next couple of years, then what we anticipate is a continued, however gradual, resumption of economic activity. And in the United States, that really is where we find ourselves right now, and that's really what's behind a lot of the optimism. As a closing point, before I turn it back to you, I will say that for the real estate market, while we've seen a lot of capital come in to the market, there's very strong bidding for assets, both on the equity and the debt side of the market. We have not come to a full understanding at this point of what the dynamics of space use will be, 6 months from now or a year from now. Whether it's the way in which we use office, the balance of working from home versus collaborating and being in person in the workplace, how we will travel and make use of hotels. There are still many questions that we are learning more about the answers to, every day in terms of what post-pandemic space use patterns and behaviors will look like. And that will be determinative of the long-term performance of some of our real estate assets. So we basically, have a framework where we drop everything, every type of real estate, every type of behavior into one of three very high-level scenarios. There are going to be some parts of the real estate market, some parts of the economy and consumer behavior where we see a reversion, a return to pre-pandemic styles and norms of behavior. And we'll call that the reversion scenario. There are some segments of the market where we expect to see the acceleration scenario dominate. And that's one where patterns of behavior and changes that were already underway before the pandemic have simply been accelerated and will continue to, we're not going to see a reversal. And then finally, an inflection scenario. And this is the one where the bar is highest. It'll be most difficult to actually observe this happen, but where truly new behaviors emerge from the pandemic that we have not seen before, and that we see them persist even after the pandemic is part of history. So we're carefully evaluating and being, I think, modest in understanding that we still have a lot more to learn about what these behaviors and patterns of space use will be 6 months or 12 months from now. Let me turn it back to you.
Nice. Let's discuss later what to expect to see into these new trends, but let's come back to Brazil.
Okay.
Then, so Cherman, now it's easy. Like Brazil, we are in an easy position. So,
Yeah,
what did you see, and what you expect to see?
Yeah, thank you, Michel, and thank you, Renato. Sam, it's a pleasure to have this chat with you, and I think you highlighted very well in terms of the people and how we expect things from Brazil perspective. We are behind the US, and Tishman Speyer being a global company, we have seen what happens in China, in Europe, in the US, and as we are behind. Vaccination, it's still lagging behind. We keep looking and seeing an optimism that we expect things to come here. But it's interesting because Brazil's been in a crisis since 2012-13, and 2019 was kind of the year that we are coming out of the big recession, and we saw the market expanding significantly, and came just in March 2020, the pandemic. And I think I'll not repeat, but we saw the same kind of patterns that we're seeing all over in terms of how we expect this to happen. And probably at this point, we know more as the pandemic is kind of getting out of us, but we don't know how things will shape up in the future. I want to comment that we see that in these different segments in Brazil, we see the acceleration that was saw in the US, like in the warehouse, in the e-commerce, that we are really behind, but this accelerated very, very much, and we see that a catch-up in that sense regarding the US. In other areas, we see some difference because, let's say in the office market, our stock our Class A stock is still 35% of the total stock. So we still need to build up and get more mature our office market. In that sense, we believe that in Brazil still have a lot to grow, and the lack of good quality space is something that we'll still need for the future. At the same time, in the current scenario, we are seeing vacancy rates increase significantly because the lack of decision, but we don't have a very large stock based on what happened in the past crisis. So we can continue to chat, and I think the other important point that is really changing real estate in Brazil is interest rates. We saw our lowest level interest rate. The world is going through a low interest rates environment, but low interest rates for Brazil it's not zero. It was as low as 2% last year, and now it's getting a correction based on inflation. It's coming back. But for the next cycle, we see that the level of interest rates will be lower compared to the historic. So we see that there is a lot to grow and a lot to expand the real estate in Brazil. And my last point is that as we are the national player, we used to bring funds from outside of Brazil to invest in real estate, and we saw that in the last few years, based on this scenario of crisis and low interest rates and volatility in Brazil, we saw our REIT market expanding significantly, as Michel was talking about that. And we see that this will continue to grow. And as foreign capital come back to Brazil, we believe we will continue to grow in this market. So maybe Michel, we can
yes,
get
nice.
back.
So let's try to get focused within the segments of real estate. I'm talking about corporate logistics, hospitality, which are the winners and losers of the crisis? Which are the sectors that will emerge bigger, and there are logical names, but like also which are the big losers, and the trend will also continue to be bad for the future? Let's start with Brazil, then we go to the US.
You didn't give me time to think, but I think some touch in a point that I think some segments are just accelerating, and there is a shift in the dynamics, especially in the e-commerce and the warehouses in Brazil is growing significantly. But this is an acceleration of a trend that was coming. So I think this is one of the winners. We are seeing also that in the retail, in the shopping malls segment, we are suffering. The US was suffering more, but this led to some. But in Brazil, I think there is some shifts in the main malls in the great cities. This will continue to be something that will grow. But the secondary cities and malls in these areas probably is changing. So this is part of the losers in terms of the acceleration of this trend that we are seeing. I think the office market, as I already mentioned, I think this is also a winner. But I think at the end of the day, the new behaviors will need to adapt to that. Also, what we are seeing in the multifamily, that is this very small market in Brazil. This is we saw some funds that starting to to start to invest in this segment. The house in Brazil is much more for condos and not for multifamily, but we are seeing that the change in behavior is bringing the multifamily to start to be a segment that will grow, but still is very initial terms. And I see that some other segments that is not present in Brazil in large scale, as like data centers, that we're starting to see as the need of more cloud and infrastructure. This is starting to happen, and the other segment that we're starting to look globally that's not existing in Brazil is the life science, that it's booming outside, and it's also the pandemic and all the investments in biotech. It's coming, so we need to look to that to see if these markets will start to happen also in Brazil.
I'd echo your point about life sciences. I think it's one of the strongest emerging sectors here in the United States, in the same way that flexible office space, anything that was supported by the technology sector, property technology, had been so much of the driving force behind innovation and space use over the course of the last cycle. In part, just because of where we are with biotech, because of the demand related to the aging of the population in the United States, because of innovations in medicine and healthcare, the intensity of research in the pharmaceutical industry, the life sciences is clearly emerging as a winner. In terms of the need for space demand as we come out of the pandemic. It's getting a lot of attention. In terms of some of the other sectors, go ahead. Sorry, Michel.
Can I do an interruption just for the overall public? What do you mean by life science? What are the difference and what's the real estate in life science?
Daniel, go ahead.
For the overall,
Sam, keep going.
Yeah. So I think, for me, I think that you could think about it in a couple of different ways. But imagine sort of the space that facilitates biotechnology research, that facilitates pharmaceutical research, biomechanical. There's a lot of it is research oriented. But life sciences campuses are not only about providing a space that will allow for the research and the operations of firms that are developing new life sciences applications. It's also about the value associated with the physical co-location of different firms and all of the complementary services. So you get life sciences hubs where, again, it's not just about a building. It's about what's the pool of labor? Does a particular market or submarket now become a destination for people that have the right skills, that have the right capabilities, the right interests, to work at the companies that are occupying those spaces, to provide all of the adjacent services or goods or materials that are needed to facilitate this type of research. I think one of the things that distinguishes life sciences work from what we see in some other sectors, or how we think about sort of the more traditional economy, is that it's incredibly interdisciplinary. And it brings together people that have many different backgrounds. It's not just sort of biologists or just chemists, or there's civil engineers, there's mechanical engineers, there's electrical engineers. There's really people with lots of different backgrounds that come together, and the space as much as the co-location play a role there. But Daniel, what would, through your lens, how would you describe it?
Yeah, and I think the need for, we're seeing the fintechs, the proptechs, the startups. So in biotechnology these days, there are firms, there are startups and trying to find new drugs and things. They are put people together as a hub, as some describes, and they need space for that connects labs and office and with the right infrastructure to evolve and attack those.
The startup space that Daniel mentioned becomes incredibly important, because when we look at the dynamics of new drug discovery, I'll say through my lens, that is a very rapidly evolving space. And you have traditional pharmaceutical companies that will try different combinations of small molecules, versus I think where we are now with something like monoclonal antibodies, where we're looking at very large molecule. The process of discovery of manufacturing techniques, it can look quite different. So this startup space actually becomes a really important element, because there's a piece of this that is seeing, what does startup X or Y do that is sort of a spin-off from a university research program. What academic institutions and medical research centers can I partner with? What is that next acquisition target for me? But having an ecosystem where there is space to support sometimes very what we refer to as translational research that connects sort of folks that may be working in academia on one side, and then in the pharmaceuticals and biotechnology industries, in the other, becomes absolutely critical here. So, the life sciences space, Michel, you could probably tell from Daniel's and my descriptions of it, an absolutely very exciting area to be, and it's sort of a very important area for investment and development of new infrastructure.
And the opposite, which are the areas that worries you? Daniel?
Yeah, I think
you
that
you had some time to think, 10 seconds.
No, I think what is really transforming and it's really a trend, I think, is the retail. The retail is something that it's really difficult to, no, it's not difficult to see where it's going. It's going, but how the real estate will support that, other than the warehouses and the deliveries, and I think this is kind of it's disrupting the market. I think other segments, they continue to be, they can adjust to the new technologies, and I think the prop tech, the investments in new technologies in the real estate, this is something that it's very important, because it's not just more about building the infrastructure, the building itself, to attend the people to the services that is involved, how you collect the data to understand, and how this transform. So I think it's not about the losers or the winners, but it's how you will face this new market. I will not say new world or new normal, because I think it's not about that, but it's about how the culture is transforming and adapting. I still believe that people want to get together, we want to go out, we want to have dinner, creativity, we need to be together to develop, especially in the university and the companies in the creativity. So this will continue to happen, maybe in different ways, but we will need to adapt to this. I don't think that will be just loser, because the market tends to adapt and tends to adapt fast to see what's really transforming.
Yeah, I agree completely. I think every sector of the economy, every sector of real estate, faces a different set of challenges as we emerge from the pandemic. What will distinguish, who does well and who really struggles is, comes back to Daniel's point. And I think it was such a key word to use: adaptability. How quickly can you innovate? How quickly can you pivot? How quickly can you adapt to a rapidly changing environment? The trends that we're seeing in retail are not new. The trends that we're seeing in industrial are not new. There is that acceleration. Over the last 15 months, we've lived 10 years of change. Certainly, a sector like retail faces a very unique set of challenges. But that also, you could also see that as a really exciting opportunity to come in and say, what do we do with this space? There won't be an answer for every space. Certainly in the United States, where we have so much retail square footage per person, more than I think any other economy in the world. There are going to be some retail spaces where their next highest and best use might be something other than retail. But so there will be a process of reinvention, as there is after any significant shock. One of the dimensions in the United States, I'm very interested to hear whether there's a parallel in Brazil, is that apart from the different property types, because each one does face a unique set of issues, we're also seeing a significant set of issues or challenges emerge with regard to different cities. Very, very big cities like New York, where our fundamental premise is that there is value in our all being here together. But being all here together in large numbers means that it's expensive, to operate a business, to live, to send your kids to school. It's not an easy place to live every day. There's no place in the world I'd rather be. But if we have this phrase that I hear more and more often, the 15-minute city, the idea that people will want to live in ways that within a 15-minute walk, they can access all of the things that they need. If we really do move towards a 15-minute city, then the value of scale, the value of being in a very, very large city, is there's going to be a bit of a challenge there. And so I think in markets like New York and London, LA, Toronto, there are in each of these cases, the city has to be thinking carefully about how do we maintain our competitiveness? How do we reinforce for businesses, for people, that the diversity of thought, of ideas, of expression, of artistic work that you only see in the biggest and most significant cities on earth, that still has tremendous value. While at the same time managing around some very practical issues. Markets like New York need to be fiscally competitive. And it's a challenge for us here that we've got to face over the next couple of years in the United States, that it's whether it's taxes or the cost of housing or the cost of the office space or the how long it takes to get to work. It's a market like New York is an expensive one. We have to make it worthwhile to be here if we want to continue to attract people. I'm confident we will, but it's going to require work.
Sam, trying to add a little bit, I think we've been talking a lot about that last year, of course, about the pandemic, and for sure, talking about New York here was, New York simply it's not gonna come back, and it seems that it's coming back. For sure, there are a lot of problems, but like in the other side, and talking about a lot to people, during last year, it was very clear that the big cities will continue to be the big cities once they continue to attract young and talented people, where they can find very good jobs and where they can meet people to get married or to get out. These are the two important things for sure to think about. If the cities if the big cities continue to have this kind of attraction, they have a good future. If they are not able to attract young, talented people, they are burned in the long term.
Yeah, I can. No, I just I think in the U.S. you have these perspectives of New York and San Francisco and the cost of living and the secondary cities that things are changing. We have maybe a different type of problem. We are probably mainly 3-4 cities: Rio, São Paulo, and maybe Belo Horizonte and others, but as big centers. But also I want to put another example of the difference of sometimes how Brazil looks to the US and see how we can continue to grow. And one of the measures was that a square footage of shopping malls per the population, and Brazil is a is a fraction of what have in the US. And this was something that we are looking here, say, there is a lot of room to grow, but at the same time, just seeing this upside down. And another interesting difference too is that right now everyone is talking about more flexibility, and you have long-term contracts in the US and keep the co-workings and give some flexibility. Sometimes you in the US are looking for reducing and get more flexible lease terms. While in Brazil, we had exactly the opposite situation where our contracts are not so strong and you can break the contract easily. So at one point, we were looking that the long-term contracts is very good and solid, and it's great because real estate is about that in the financial markets. But at the same time, now you're bringing more flexibility. And in that context of the office market, we see that density of in the US is one person every, let's say, 12 to 14 square foot. While in Brazil, we were densifying too much. And when you talk about this trend about maybe how the big cities will keep their attracting people and the young people, we see that here we were densifying too much at the point that some companies say, no, we want to go for a secondary city, let's go outside of São Paulo because I cannot get even enter in an elevator because it's too tight, it's a lot of people. So the point is that it's not that the building is too dense, that the companies are densifying too much, and we need to put less people in the buildings to be much more pleasant and sustainable. So I think this is also going to be an important point here in Brazil because densifying too much, this is over. And how people will use the space, it's something that will change, but the need of good quality will continue to be a trend.
Nice. Going specific to questions, what about prices? Is there any chance of overheat like in 2008? What do you see the perspective in Brazil, in the US about real estate prices today? And for sure, taking account all of the real estate, all of the interest rates jumps and downs that happen over the last quarters. What are your thoughts?
I think in the United States, it depends obviously on two key things. One is, are there sectors of real estate where investors are overly optimistic with regard to the recovery in the underlying leasing fundamentals? And there are certainly some parts of the office sector and some segments of office where I think we do need to be careful and thoughtful in our underwriting, whether we're on the equity or the debt side of the market. That's certainly a factor for us. What's really helping to support fundamentals in the United States, though, and helping to justify those prices, is that quite frankly, it's been difficult to build. And as compared to previous cycles, we have not seen additions to the inventory broadly that are comparable to what we've seen during past real estate expansions. A lot of that has to do with, some of it has to do with the availability of land, the availability of skilled construction labor, and the cost of the materials to build have been significant barriers or drags on development activity over the course of the last 10 or 12 years. And we've seen that become even more challenging during the pandemic in areas like softwood lumber, where prices have, I think, depending on the day, they've been trending up, and right now they're more than double where they were at the beginning of the pandemic. So softwood lumber sort of has an impact on one type of real estate construction certainly more than another. It's not going to be as relevant for commercial as it is for residential, but that constraint on development and inventory has been a feature of the market. The overall, are there going to be some folks that make strong bets on the recovery in hotels and business travel in a way that doesn't quite play out? There's always going to be some of that. Is there is industrial overbought? Overall, I don't think so. Are there going to be some parts of the market, some locations where we need to be a little bit careful because there is so much excitement about fulfillment centers and other types of industrial? that always, these types of things, there are always going to be segments of the market that are, that are experiencing a surplus of capital. And overall, I think that does, characterize a little bit of what we see going on. There is such an abundance of capital available in the real estate market relative to the number of opportunities to invest and lend, that in itself is exerting some upward pressure on prices. The final point on this is that a lot is going to depend on what happens with prices. We have not had to contend with significant inflation in the United States for quite a while. And the potential for stronger inflation in a way that requires tighter monetary policy, I think this is a concern. It's not necessarily the baseline outlook, but it's a concern for many policymakers, many economists. I do worry about a $1 trillion infrastructure program. While we desperately need investment in infrastructure in the United States, if we drive demand for infrastructure by spending $1 trillion, but don't also invest in ensuring that material costs are managed, that people are being trained in how to work in the construction fields, that young people are going into these areas, that we're addressing trade disputes that are limiting our access to some of the inputs that we need for construction, then I think what we'll find is that we're spending a lot of money on construction for infrastructure. It crowds out some private investment because those dollars are competing for the same labor and the same materials and the same land that the private development would, and that I see as problematic. But there's that would be a policy problem to which there's also sort of some policy balance that's necessary. We don't want to lose private development.
Yeah, no, I think here I think it's a slightly different story. Inflation is back. And the discussion is that, okay, central bank and the government will increase interest rates to control inflation. If this is just a short-term pressure based on the consequence of the pandemic because of different disruption in production, or is a trend that it's kind of moving further out. And I think in the last year, maybe Michel can comment more about the economy, inflation, from the bank perspective, but in my view, inflation is already hurting the cost. Brazil, it's our leverage is not that high, so our pricing it's very close to replacement cost plus, let's say, a margin. And this is the way that the market works here, especially in the residential market. In the office, you talk about caps on leases, and something that changed that dynamic. The pandemic changed the dynamic is that you used to have prices in Class A office higher than prices in high-end residential, and today is the opposite. And is the opposite because families find the needs of a better quality home. They are spending, they have the money to buy an apartment, while in the office side, you see that rents are downward pressured over the last few years, and as interest rates goes up, caps needs to go up, the yield, you need to get a better yield. So that is pressuring price in the office. I think this is momentarily, because as pandemic gets out, we'll see prices coming back. But prices will have to increase because inflation is here and the construction cost here is going up, and we need to face it right now.
I like going to the basic of the economics. I agree with you. Like the main problem in Brazil is that the first wave was regarding to the dollar FX, so went up a lot the dollar. So materials went up a lot. That was the first wave of inflation into the real estate sector, and now we have the second one. There is less predictable, but it hurts a lot. As we don't have a high volume of qualified people working as a labor, probably inflation on the labor side will be high. Having said that, we see that the central bank is doing an amazing job in Brazil. When they had to put the economy to work again, they lowered very well the interest rates. Now they are coming back the curve. Our main scenario for sure is going to be around 6% interest rates by the end of this year, beginning of next year. Inflation this year will be high, but next year will be at 3.5%, around 3%. But the most important point, the financial deepening, that is what's happening, starting to happen in Brazil, in the economy. We continue to see this scenario as the long-term scenario for the economy. Having said that, that for real estate is really amazing. So for sure, like we had very few international investors investing and trusting the country right now in the last years. For sure, Tishman by far one of the largest ones, and Daniel has been doing that for several years, and it's important for us in the economy. But also the local economy improved a lot. Like we didn't have any investors in local REITs, our real estate investment trusts. Right now we have roughly 1.4 million investors. Just in our funds, we have more than 500,000 investors. We have several funds with more than 300,000 investors. So local economy is performing on that, and this is the trend of the financial deepening. That is key. And we know that real estate is a long-term investment. So it was very complicated to be tracking on a 2 to 3 year investment, very difficult to do real estate. So I think we are in a good mood right now over the last years, exactly because of this financial deepening.
I agree.
So one extra question that I had here, what about home office and office? I think it's much easier to talk about that on the US standpoint, because most of the banks are saying that. Yesterday, Morgan said that you should come back to work. Goldman, the same thing. So we are behind, like we are 3 months from there. So what are your perceptions, Sam?
Sure. Well, I mean, I think in the United States, there's a lot of press that where from the headline, you would think that it was a binary outcome, that either no one ever comes back and we never see anyone again, or everyone comes back and it's just like the pandemic never happened. Highly unlikely that we will see either of those two extremes. Instead, what I think we see happening, and it will take some time for the data to really reinforce this. We want to see where things are, and how things evolve over the next 6 to 12 months as sort of we get more universal vaccination. But I think what we see is that for any one of us, depending on our function, our role, the type of work that we do on any given day, there are some things that each of us will do where we can be more efficient and productive working from home or some remote location, and some things that we do that we really benefit from being physically co-located with our peers, with our colleagues, with our partners, whether they be internal or external to our company. And so what happens is that different companies doing different things will each find their own balance, and that balance is going to depend on sort of what makes the most sense for optimizing the company's output and performance, with an eye to also providing for every company wanting to attract and retain the best talent. There's going to be some element of this that's also about what kind of flexibility do I need to provide to make sure that I'm the place where the best people want to work. And so you can imagine some balance there. And depending on what industry you're in, that balance is going to be different. Depending on what your role is within an organization, that balance is also going to be different. The last point I'll make on this, because I emphasize it so often for my students as they're looking for summer internships and jobs. If a company gives you the option of working from home permanently or coming into the office 2, 3, 4 days a week, go into the office. Particularly as a young person, you will not have the opportunity to build the network, to build the trust relationships, to find the mentors, to find the champions for yourself within your organization, to learn, from others. in the same way if you're online as in person. It is so critical for the early stages of your career that you have meaningful interactions with other people, and that is going to happen in person in a way that we just can't replicate online. The three of us, we've been able to rely on relationships over the last year and a half that we've developed over decades. But even for us, after a while, the relationships begin to deteriorate a little bit. It is so important that we see each other again. So people do go back in. I think that does become important. In terms of the residential sector, where this does also become important is that while a lot of the focus has been on people leaving a big city to go to a secondary market, what we actually see is much more likely is that folks are saying, if I'm going into the office 2 days a week or 3 days a week, then the relevant geographic area over which I can optimize, my family's location, where do I choose to live in the city or in the metro area? If I have to go in every day, then I need to be a little bit closer in. The more flexibility I have, the greater the radius. It doesn't mean that I'm going to move further away, but it expands the range of options. And particularly for young families that may have children that are thinking about what's the right school for me to send my son or daughter, that can mean in a lot of cases in the United States that you do choose to live a bit further out. And this is part of why in many metro areas we see very strong demand for housing outside of the urban core, and then a relatively more modest set of outcomes for residential housing in the downtown area over the course of the last year and a half.
Yeah, no, I think it's I should agree more with what you were saying. I would add that if you are 100% in home office, probably you are in an operational job, in something that in a few years or months, maybe your work will disappear because the bots will be doing your work. So I think as for the young people to go and networking and the companies, even the large tech companies, they used to put more entertainment in the office, food, so people can stay more. This was the trend: people getting together and getting more time together, and not going outside. So I think this balance it's going to happen based on what you said. And just a comment here in Brazil, especially in São Paulo, we saw this trend based on the legislation that restricted to build larger apartments, and most of what was launched and sold in the city over the next few years, it's smaller apartments. And then you say in the press that people were going for home office. So you are leaving the office, the good quality office with good environment, with everything, to go to work from home in a small, even smaller apartment. So doesn't make sense that something is wrong there. So I agree that we'll see a balance, but I think people socializing, get together, this it's continue to be something important for the human being in general.
Nice. So we are coming to close to the end. Let's go to our final thoughts. So Daniel, do you have anything?
Yeah, no, look, I think it's a very good conversation, and I am optimist about the world and Brazil. I was thinking that by May, June, we are going to be out of this. I think I was wrong, but I'm glad that probably I was wrong for just a few months. And as we are getting vaccination till this year, and things are getting better, economy is improving, we see the markets, people are getting more motivated, even though we still need to be very careful in this next few months. But I'm very positive about what's coming, and looking for the U.S., especially New York, that we get with them, with our teams there. We get more optimism every day that comes. So thank you all very much for this opportunity and that very good conversation.
Thanks. Sam?
Similarly, thank you so much for hosting us, and thank you to Renato. I've been planning my trip to Brazil since the spring of 2020, so I hope it will happen this year. Otherwise, early 22. I'm so excited to make the trip, to see so many people in person, and I've been able to meet people from all around the world over Zoom over the last 15 months. But the human connection is so important, and is the fundamental reason, the fact that we are social animals, and that we can engage in collaboration, idea generation, and trust building when we are together at the table, is a key reason why I'm optimistic about urban markets and commercial real estate. I will say two things. One of the things I'm watching, apart from the potential for global inflation, that I think we'll need to be careful of and monitor closely over the next year, will be the management of debt, whether it be corporate debt or government debt. Around the world, in emerging economies, developed economies, and you go around the world, doesn't matter where you look, the growth in the level of debt implies significant risk to the stability of the global financial system. Some economies will be able to manage the growth in that debt more efficaciously than others, but it's going to require that we watch this very, very closely. It's a potential source of global financial distress that we have to monitor. The other thing I'll say in closing is that, again, we're very fortunate in the United States that we've had preferential and early access to vaccines. It is in our interests in the United States, as well as the interests of people all around the world, that we ensure equitable access to vaccines, so that people in all parts of the emerging world, in North America, South America, and until we have all had the opportunity to get vaccinated, the risk remains. And so equity and ensuring that people around the world do have the opportunity to protect themselves and the people they love has to be one of our global priorities this year and next.
Excellent. So, Sam, first of all, once you come to Brazil, let us know. Our office is open. Let's do a physical meeting. Let's go for sure, everybody, from the NIU standpoint. You can use our premises. Renato is a very good friend and also helps a lot. So keep that in mind. And Daniel, Sam, and Renato, thanks a lot for your time. And let's do in the future a new one. And I like what Daniel said. Like, we are not very good, but like we are starting to see good light at the end of the tunnel. That's the hope right now. Maybe 2-3 months from now, we come close to what you have down there. Thanks for everybody. Thanks for the time. Thanks the audience. Bye-bye.
Thank you.
Thank you.